Brad Williams, Frugal Finance. 8 things you should know before trading Forex. Forex is currency futures. Commodities Future Trading Commission advises the public to thoroughly research over-the-counter foreign exchange dealers before making initial deposits or handing over sensitive personal information. Research should include verifying that the dealer and its employees are registered with the CFTC and checking the dealer's disciplinary history with the National Futures Association. Recently, the CFTC has seen an increase in fraud complaints from customers who deposited large sums with unregistered offshore Forex dealers. The customers found these dealers through social media friendships or recommendations. However, when the customer tried to withdraw their money, the dealers were unresponsive or demanded additional payments. Registration alone may not protect you from fraud, but most frauds are conducted by unregistered dealers and individuals. Financial requirements, examinations, and state and federal laws are also intended to help ensure a registered dealer meets its obligations. This is important in a market where the dealer is your only counterparty. 8 things you may not know about Forex. You're trading against the dealer. Unless you're buying Forex futures or options on a regulated exchange, you're trading off exchange or over the counter. This means you're not trading in an open market. You're trading only against your dealer. When you buy, your dealer is the seller. When you sell, the dealer is the buyer. Your dealer makes money when you trade more frequently, lose money, or pay fees, spreads, or commissions. 2 out of 3 Forex customers lose money, at 66%. Most OTX Forex customers lose money when all credits, financing charges, fees, and other expenses are factored in. Over the past year, about 1/3 of customers at registered OTC Forex dealers made a profit, while 2/3 lost money. The dealer controls the trading platform. When you trade over an electronic trading platform, mobile app, or a dealer's website, you're not connecting to a live exchange. You're connecting to a dealer which controls the information you see on your screen, including prices. In many cases, unregistered offshore dealers have used popular trading software to provide a veneer of legitimacy, but have manipulated trade data to steal from customers. Compare prices with third-party sources to verify you are seeing legitimate market prices, movements, and levels. Your ability to close or offset positions is limited to your dealer. Because you're trading against the dealer on his platform, you're limited to the prices and conditions the dealer offers. Your deposits are not protected. If a dealer disappears or goes bankrupt, you may not be able to get your money back. Before opening an account, be sure you receive and closely review your account agreement to see what rights and protections you have. Next, check requirements for funding and withdrawing from the account, including any related charges. Fraudulent dealers commonly refuse withdrawals until customers pay expensive, undisclosed commissions, pay made-up taxes, or invest more to reach a higher account level status. You should never have to pay more money to get your money back. You can lose all of your margin and more. OTC Forex trading uses margin. Dealers will require a minimum amount to open and maintain a position, which usually depends on the volatility of the currency pair you want to trade. For example, a 2% margin requirement means you could open a $100,000 position with only $2,000 in your account. This high degree of leverage amplifies both gains and losses. If the market moves against you, you'd be required to add more money to your margin account or close the position. You may also be liable for additional losses beyond your initial deposit. Salespeople may have hidden conflicts. The dealers may employ salespeople, social media influencers, or affiliate marketers to bring customers to its platform, but these relationships may not be known to your customer. Salespeople may have no expertise in trading and get paid based on the number of new customers they deliver. Thoroughly investigate any statements that contradict or downplay any of the issues listed in this advisory or other risks outlined in the mandatory risk disclosure statement you must receive prior to opening an account. Many frauds begin on social media. Be especially cautious of anyone who approaches you on social media, dating apps, message apps, or through unsolicited mail wants to discuss Forex trading. Common warning signs to watch for include pushing you to move the conversation off platform to private messaging app, promising outsized and often guaranteed returns in a short amount of time, directing you to an unregistered dealer with no physical presence in the United States, offering you leverage that is higher than legally allowed in the United States, 2% for major currency pairs or 5% for other pairs, accepting only Bitcoin, Ethereum, or other digital assets as payment, having a website that does not display a physical headquarter address or branch location, or the addresses do not exist, you do a street level map search, using a WhatsApp customer service number or having no phone number at all. If you believe you've been the victim of fraud, visit the CFTC. If you have any questions or concerns about the spammy or fraudulent nature of the Forex market, comment. This information provided by the CFTC. Brad Williams, Frugal Finance. Thanks for watching. Hope that helps. See you soon.